Hello, ladies and gentlemen. This is Steve Harney with the December edition of Keeping Current Matters monthly market report. Well, as you know, we believe very, very strongly here at Keeping Current Matters that most agents know what's happening. Good agents understand what's happening, but great agents, KCM members, they can explain what's happening. And there's a big difference between understanding something and explaining something. Because if you can explain what's happening in the market right now to your clients, you're going to build a trust with them that no other agent in your marketplace is going to be able to do. You can actually sit down with a buyer, sit down with a seller, and explain to them the craziness of this market. And I'm going to start with that craziness to 2024 forecasts. Now, if you look up at the top, we have a crystal ball there. The reason we have a crystal ball there is forecasting anything in today's market is really like kind of rolling the dice. So I'm going to give you the forecast that major entities are doing, both on home prices and on total home sales for 2024. All right, let's start with the prices. We can see they're all over the place. Realty.com thinks we're going to be down 1.7%. Zillow thinks we're going to be down 0.2%. The other end of the spectrum, Mortgage Bank Association thinks we're going to be up over 4%. The middle is just under 3%. And to the Goldman Sachs, I wanted to throw in one of the major banks so that you get a feel for what they're thinking. All right, that's 1.9%, and NAR's 0.7%. If we average all of those together, that's the blue column all the way to the left, you have 1.5% appreciation. Now, ladies and gentlemen, to be frank with you, I am not sure how much appreciation we're going to see next year. I think it's going to be relatively flat. We're not even going to see normal appreciation, which is 4.92% over the last 40 years. I think we'll build below that. I think there's a chance we'll half that and be about 2.5%. All right. That's not bad news. That's good news. We need home price appreciation to slow up a little bit because of the affordability crisis we're in right now. So we need two things. We need home prices, or three things, actually. We need home prices to slow up a little bit, wages to increase, and most importantly, mortgage rates to moderate even further than they already are, which we'll talk about in a second. As far as total home sales forecasts are concerned, Fannie Mae still has us just below 5 million, and about 5.2 million is what would be the average over like the last 10 years outside of the what we call the unicorn years, the pandemic years. All right, because they were definitely unicorn years for the real estate market. All right, we can see that if we average them all together, they're just about 5 million, which will be about a 20% increase over what we did this year. So the forecasts are looking very, very positive. The pricing is saying it's going to be relatively moderate as far as appreciation is concerned, but sales are going to pick up. Now, the reason I gave you the sales second is I want you to understand, I think we have the potential to blow those numbers away. I think that we're coming into a time right now that the market's about to turn in a very, very positive way. And let's give you a couple of reasons why I think that. Let's start with mortgage rates. And whenever we're talking about mortgage rates, I want to let you know what was the day we did the slides. The day we did the slides was November 30th, 2023, because they're so volatile. We want to let you know that by the time you listen to this, mortgage rates might be in a different place. But if we look at it as of the end of the month of November, what we can see going all the way from July, there was a slight uptick, and that uptick actually started to increase when we got into September, as we know. And we almost hit 8%, all right, on the Fannie Mae, on the Freddie Mac numbers. We actually did hit 8% of the daily numbers, all right, but in Freddie Mac, we got as high as 7.79. Then we've progressed downward in a good way down to 7.22. And I will tell you that as of this morning, while I'm recording this, which is December 4th, all right, I want you to know that interest rates were at 7.09. Now, if you remember, I said there's nobody knows where mortgage rates are going. No one knows that. But if somebody was holding a gun to my head, this is what I said 2 months ago, I think we would have a shot at hitting the sixes by the end of the year and that we could get into the fives by the middle of next year. I then said, but my opinion is not worth any more than anybody else's opinion. And I still believe that. But I do think we do have a shot at 6 by the end of this year or at the beginning of next year. And I do think that we have a shot at some 5 number sometime in 2024. If that happens, I think it's going to be a very, very active market, very, very active market, because 2 things are going to happen. More inventory is going to come to the market, and we need the inventory desperately, well-priced inventory desperately. And the second thing that's going to happen is that the buyers, more and more buyers, are going to be eligible to purchase a house. And we have to remember that every time we sell a listing, like 70% of the time, that also creates a buyer, because the person selling their house needs to buy a house, the next house, whether it be a move up or move down, whatever the case may be. So I think it's pretty interesting, and I think that we have some, very strong data right now to share with you to say, all right, let's take a look at this and see, is 2024 going to be much more of a breakout year than most people are projecting? Let's start with buyer demand. Buyer demand is actually up over the pre-pandemic years, 2016, 17, 18, and 19. There are more people out there looking at houses. Now, that number is a little bit skewed because there's such a lack of inventory. There might be one person looking at 3 houses where before they might have looked at 1 house. So I'm not saying that data is not a little bit skewed, but what I am saying is, it's not in the 90s. There are people out there looking to purchase a home. As a matter of fact, Zillow's latest market report said, despite mortgage rates reaching 23-year highs, which was when they were going toward 8, low inventory levels are spurring surprisingly strong competition. Depleted inventory stocks are gradually recovering and price appreciation is slowing. Both things are good, but demand has remained resilient and attractive, appropriately priced listings are moving quickly. Ladies and gentlemen, I want you to, hear that last part of that sentence again. Attractive, appropriately priced listings are moving quickly, because I'm going to come back to that later on. Mike Lane, Vice President of Showing Time, buyers and sellers remain active in every economic environment, including when mortgage rates are high. Buyers determined to find a home they love will continue visiting homes with their agents. As we mentioned previously, some sellers are reducing prices, which presents an opportunity for those buyers. Now, when we're talking about pricing, very obviously, he's talking about list price. And I don't think that there's no evidence, and we'll give you the pricing in a second, there's no evidence that prices are going down. What he's talking about is sellers that have been on the market, the active inventory that's been on the market 60, 90 days. They're realizing if they're not selling in this market, something has to give. And in most cases, what they're doing is they're making the proper adjustment in price. That doesn't mean values are going down. If a house sold for $500,000 across the street, say 6 months ago, and this listing listed their house at $550,000, even though it's the same exact house, well, it was $50,000 overpriced. If we now hear that they took a $50,000 price reduction, we think, oh my God, prices are falling. No. They're just bringing that house back to its real value. Understand that there will be people out there that will misunderstand that. They'll think, and I see it all the time on the internet, they say, listen, this house was priced at this, and now it's priced at that. Yeah, well, it was probably mispriced to begin with. So we always want to jump back to the pricing indexes, which again, we'll go over in a second, to see really what's happening with value. Are they going up or are they going down? Now, the big key is affordability, ladies and gentlemen. It's a major, major, major key to, us having a really good 2024. But one of the things I want you to understand when they're talking about affordability, because the headlines in the news is kind of a little out of whack. They keep on saying, like, we'd have to increase wages by 63% to reach the affordability of 2 years ago and 2.5 years ago. They say we have to, mortgage rates would have to drop down to 5% or under 5% to reach the affordability we had 3 years ago. They'll talk about the fact that prices have to drop dramatically in order for us to reach the levels we had 2 years ago. But when we're talking about affordability, ladies and gentlemen, I want you to remember this graph, because what they're saying is, well, if we go back 2.5 years ago to January 2021, they're right. It's going to take a lot to get to that number. Well, that's one of the lowest numbers in American real estate history when it comes to mortgage payment to income ratio. This is the affordability index from NAR, a portion of it, where they say, well, how much of your income has to go to a mortgage payment, a median income, median family income to a median home, median priced home. We don't, if people think we're going to go back to 13.3% or the 11.6% we hit in January 2013, that's unrealistic. Just like they're saying now, it's the highest unaffordability index, meaning like it's the worst. Well, the same thing here. We're not going to go back to the lowest ever. We're going to go back to norm, and the norm is 25%. And if we look at the numbers that we see right here, what we can see, ladies and gentlemen, is that we're not that far off of that. If wages come up and mortgage rates adjust, we'll be at that 25% mark. We won't be at the 13.3% mark. We might not be back to the 13.3% mark in my lifetime. But we're not trying to get back to the greatest affordability of all time. We're trying to get back to normal affordability. Those are two different things. And when we're talking about affordability, the one thing that always irks me a little bit is a financial equation that people always use, but very rarely do they talk about the equity buildup, because that's part of the financial equation. Rent versus buy. Well, if you rent, you can get your monthly expense, at least for now, less than if you bought. But what nobody does is they don't put the equity buildup into the financial equation, and I think they should. As an example, here's the last 30 years, all right, actually 32 years. At the FHFA goes all the way back to 1991. The reason we started in 1991 is because that's when their data starts. And what we can see is anywhere in the country, there's been dramatic appreciation over that 30 years, to the point of the national average is over 300%. So when you buy a house, you're right. You might be able to rent a house for a little less money than you can buy, maybe even a lot less money than you can buy a house right now. But there are a lot of other expenses that we're talking about, a lot of other benefits that we're talking about, okay? So is demand really strong? Well, some people will argue that, well, demand's really, really not that strong. It's just that, the more people are looking at more houses, less people are looking at more houses, and it's skewing. Well, here are two things that prove that, no, demand is still very, very strong. Here's the average number of offers received on the most recent closed sale. And what we can see is, though we're down from the unicorn years, those, crazy years of 20 and 21, we're still above the pre-unicorn years. There are more offers per listing today than there were in 2018 and 2019. And there's more offers per listing this year than there were even last year. So yes, demand is still strongly there. Another indicator that we should take a look at is the median days on market. Now, people will say, well, let's compare it to 2021. Well, why are we comparing it to the lowest number ever? Let's compare it to the pre-pandemic, the normal market. And what we can see is we're selling houses much quicker than we were in the normal market. So yes, demand is there. The question is inventory coming? So let's take a look at the inventory numbers right now. Number one, active listing count is still well below what it was pre-pandemic. So I'm not saying that when I talk about some positiveness, as far as listings are concerned, I'm not saying we're back to normal. We have a lot of work to do on the listing side of it. But what I do like, if we look at the black line, the solid black line going across, that's new listings this year coming out month to month. The dashed line, all right, that line is where normally it would go. If you look at the other years, and we go all the way back to 17, we give you 17, 18, 19, 20, 21, 22. This time of year, new listings dive as we're going into the holiday season. But this year that didn't happen. I think that we're seeing, which we saw on the buyer side almost from the beginning, that the sticker shock of going over 5% on the mortgage rate, then over 6% on the mortgage rate, then over 7% in the mortgage rate, that sticker shock, the buyers got over that pretty quick. Sellers, not so much, mainly because they probably had a mortgage under 4% on their current home. But now it appears, and it's several months of this now, it appears that the sellers are starting to get over that sticker shock. Whatever need they had to move, they're not waiting anymore. They're starting to bring the listings to market. So if demand is high and listings are starting to come out, now we have some pretty interesting information. As a matter of fact, the week before Thanksgiving, 58,000 new listings came out. In that week, that same week, 10,000 of those listings sold. So I want you to understand that we're the work that you put in over the last couple of months, all that prospecting, all that work that you put in, you probably didn't get a great return on it. You had to put the work in because you needed to, make deals, but you probably didn't get the same type of return you would get in a different market. Well, I think that your return on investment in the work you're doing now is going to increase pretty dramatically. People are ready. To look at this graph a slightly different way, what we can see, pretty interestingly, is that this is the first year since 2017 that the number of new listings went up in November instead of going down. So again, I'm seeing some real positiveness. On this graph, you want to be blue, meaning there's more inventory than there used to be. Year over year, most of the country is blue. Month over month, most of the country is blue. So now what we're seeing is there's more listings coming to the market. And we have to be prepared to get our share of those listings coming onto the market. Where are those listing opportunities? Let's take a look. Let's put a strategy together as to who we're going to prospect. NAR's 2023 profile of home buyers and sellers came out, and this is what they said about the sellers. Of sellers who moved at least 100 miles, and I want you to put that in your head, because remember, a couple of months ago, we talked about the grandparent wish. They want to be near their grandkids. We'll take a look at this. Now, we didn't have this data then, but we kind of had a feel that that's where the market was moving. And look what actually took place. The vast majority of sellers who sold over 100, they moved over 100 miles, were over the age of 55. So it wasn't the young kids getting a job someplace else in the country. It was the boomers moving more than 100 miles. And what people always say when I say that, they say, yeah, well, that's because they retired. They went to the retirement home. Well, let's take a look at it. The top 5 reasons why sellers sold and moved at least 100 miles. Now, we don't have it broken down by boomers, but these numbers are so out of whack that many of the boomers in that category. The number one reason was not moving due to retirement. As a matter of fact, the want to move closer to friends and family more than doubled the reason of moving due to retirement. 74% of the people who moved at least 100 miles, that was the situation. So what are we looking at right now? We're trying to look for boomers. This is one of the categories we're going to go after. We're trying to look for boomers that really, really, need to get out because they want to be with their family. And ladies and gentlemen, I can tell you personally, that's a very big pull once you get past the age of 60. It's a really big pull. I always tease, there's no grandparent in this country that trusts their children to raise their grandchildren. They want to get involved in it. Now, the other thing I want you to know that came out of that report is number of weeks that it took to sell a house. Now, this is crucially important that you understand the graph, because what this graph is telling us, if you didn't sell in the first month, the chances of you selling aren't good. And what does that go back to? Your existing inventory, ladies and gentlemen, the inventory that has not sold yet, that's been on the market at least 60 days, you have to go back and reprice that inventory, which we'll talk about in a second. Now let's go to home prices. We talked about demand. We talk about inventory. Well, how is that all going to affect prices? I broke down this year so far. The latest information available through any of the repeat sale indexes, because they take time to process all of the sales, is in September. And what we've seen very easily is that prices have remained pretty much even in each one of the indexes, showing what? Every month prices have gone up. Outside of January, every month prices have gone up. So this fear that prices are going to fall is not real. However, I want you to understand that we're not making a dent in the number of people that think prices are still going to fall in the next 12 months. 23% of consumers, based on a Fannie Mae poll, think that prices are going to fall in the next, depreciate in the next 12 months. Now, the good news is that's down from 37% in January. But the norm over the years, that number was like 12, 14%. So there's still a lot of people. 1 out of 4 still believe prices will depreciate, just about. And we have to make sure that we're in front of those people to the best we possibly can. So we can let those people know the graph I just gave you and the graph I'm about to give you, that they understand what's happening with pricing. Appreciation is going to slow. It's going to slow this time of year, and it's going to remain soft next year. That's not a bad thing. If they have that house for 30 years, this is what I promise you. That graph I showed you, or that chart, that map I showed you, showing that on average, it went up 300% over 30 years, prices. Over the next 30 years, it's going to do the same thing. But we're not going to have a strong year next year. That's the point that I'm making to you. Now, as things are softer, there are going to be some headlines explaining, well, prices are falling, and they're not. This is what they're confused about. This is the normal 49-year average. I've given this to you a couple of months ago. At the 49-year average, how much monthly prices increase. Now, this is non-seasonally adjusted, which is a little bit different than the other graph I showed you. Most people report seasonally adjusted because, year over year or month over month, so we can see that. But when we go back 49 years, we want to say, well, actually, how much does a house go up every single month? And what we can see here is during the spring, prices go as buyers come out, and there's a lot of excitement about buying the house. Prices, appreciation rises. It accelerates. Then starting in the summer, it starts to decelerate through the rest of the year. Now, the last couple of years, you could throw this out because prices were all over the place. It wasn't normal. That's why we call them the unicorn years. It wasn't normal. But this year, now I'm taking this slide, minimizing it, and putting it against price appreciation this year. And what do we see? We started out slower than we normally would. Because remember, last year, the last couple of months, we actually had depreciation because we had so much excess appreciation in the first half of the year. But what's taking place right now? We're going back to normal month-over-month appreciation. We're going back to the 49-year average. That's good news, ladies and gentlemen. We don't have skyrocketing appreciation. If we did, the affordability chart would fall to the bottom of the floor. We're going back to normal appreciation. Now, because it's less per month, meaning the appreciation is decelerating, what are some headlines going to say? The people who don't understand, they're going to say, prices are falling, prices are falling. No, they're not. They're rising at a slower pace. There's no red bars. They're just rising at a slower pace. And where are we going to finish this year out? And we're pretty close to the end of the year. This is what the projections are that we're going to finish out. Now, we'll know in another 6 weeks, 7 weeks, exactly where we finish out. But it's kind of strange that there's such a disparity, especially with NAR. Now, the only thing with NAR, one thing I have to give them credit for, they do it quarterly. So the next quarter might jump up dramatically. But what we're seeing is we're going to be like normal appreciation. What did I tell you was normal appreciation? 4.92%. If we average out these 6 price forecasts, where are we at? 4.6%. So this year is going to be a normal year in price appreciation. Next year may be a little bit lower than that. What does that all mean to you? It's vitally important that you understand there's a tremendous opportunity sitting in front of you. All the hard work you've done in the last year, you got X return on that investment. All the prospecting, all the mailings, all the social media, everything you did, you got X amount of return on investment. I think over the next 90 days, same amount of work, you're going to get a 2X return. Maybe a 3X return. Because the market is opening up. Mortgage rates are falling, not skyrocketing. Inventory is starting to come back to the market. Buyers are still very much in desire of home ownership. So we have a tremendous, it's just like we had a perfect storm that everything went wrong in the middle of 2022. I think we have a perfect storm where everything's going right at the beginning of 2024. So what do you need to do? First off, let's just say this. You're going to be going into the holiday season. You should take off time with your family. You should, if you're going to take a week, take a week. If you're going to take 2 weeks because you're going someplace special, take 2 weeks. Don't take the month of December off. And don't take the first half of January off. Whatever time you're going to take. But while you're taking that time with your family, you're going to have, especially during the holiday season, you're going to see a lot of people. You're going to be going to dinners, family dinners. You're going to be going to church gatherings. You're going to be going to office parties. All right. And if you're going with your spouse or your partner to an office party and they know you're in real estate, or you're at the family dinner that your whole family knows you're in real estate, or if you're at the church, hopefully you've let them know you're in real estate in your house of worship, they might start asking you questions. 2 weeks from now, you might get bombarded with questions. Please take some of the slides we've just shown you and put them on your phone. Take some of the slides we've shown you over the last couple, put them on your phone. Whatever you think is the most important information to have. I get that you want to show pictures of your grandchildren. I do too. I get you want to show pictures of your new house. Yeah, everyone does. I get that you want to show pictures of what you had for dinner last night at a fancy restaurant. Actually, I really don't get that because that seems crazy to me. But that's what you normally. You're in the real estate business. On your phone, have a couple of real estate slides to better or more easily explain the point that you're making. Did I mention up front that the great agents can explain what's happening? Now, 90-day work plan. Be prepared for that. No question there. Price adjustments on yours, meaning every one of your listings that you have right now, if it's more than, say, 60 days, bam, you want to get a price reduction on that. Price adjustments on theirs. What does that mean, Steve? Go after expired listings. If they're expiring, they weren't priced right. Get to that expired listing. Don't assume that it's not going to sell. Don't assume because it didn't sell, it's not going to sell. Maybe they just had an agent that wasn't truthful with them. They had an agent that wasn't strong enough to say, it ain't going to sell at this price. We have to make an adjustment. So adjust. The easiest way to get a listing right now is go to your current listings and get a price adjustment. Get a saleable listing right now is to go to your current listings and get a price adjustment. The second easiest way is to go after expires, especially the beginning of the year, ladies and gentlemen. A ton of expireds are going to expire at the end of December. A ton. Some are going to expire on December 31st because that's what agents do. They think that, all right, let's take it to the end of the year. Now, there's going to be another group that expire on December 30th because there's some agents that don't know they're 31 days in December. All right. But at the end of the year, there's going to be a lot of expireds. Be ready to work those expireds because now we're coming into a time they're going to be able to sell if we price them right. Work your FSBOs, ladies and gentlemen. Big, big, big. Prospect, prospect, prospect. Like I said before, you've been working hard all year. Your return on that investment hasn't been the same as it has been in the past. But whatever that return on the investment and anything that you were doing to prospect, if it was X, it's going to be 2x or 3x over the next 90 days. Don't slow up now. You're a couple of shovelfuls of dirt away from the gold. It's right there in front of you. And I'll reiterate, if your listing hasn't sold in the last 60 days, maybe it's time to have a tough conversation. And ladies and gentlemen, I know it's not an easy conversation. You, together with the seller, set the price. But remember, the other thing you did when you were sitting at that listing is you promised them two things. You promised them you were going to give every effort you could to get the house sold, because that's what they wanted. And you also promised them that you would be truthful to them. You would tell them the truth. Well, if the truth right now is in order to get the house sold, they have to adjust their price. If you don't have that conversation, you lied to them at the listing. Because you're no longer that promise that I'll do everything I can to get the house sold. Well, right now, to get the house sold, you have to sit in front of them. And you can do that. You also told me you tell them the truth. The truth of the matter is, if it hasn't sold in the last 60 days, it needs to get adjusted. The price needs to get adjusted. To help you with that, as KCM members, remember, we have the 5 elements of the perfect listing presentation, because you're going to be going on a lot of listing appointments over the next 90 days, ladies and gentlemen. I guarantee you that. So if you need help with that, bingo. If you need help with the expired listings, we have another guide that is the 3 steps to winning expired listings. Refresh your memory on expired listings. That's going to be important too. And remember, ladies and gentlemen, every single Monday, 11 o'clock Eastern, 8 o'clock Pacific, and you know what time it is if you're in the middle of the country, we do a deep dive where we take one subject and we dive deep into that one subject. We give 30 minutes on that one subject, whether it be home prices, whether it be mortgage rates, whether it be accessory dwelling units and what that means to the real estate market right now, whether it be investors and how many investors are really buying how many houses. We do a deep dive. So always be looking for the deep dive, which is Facebook Live on the Keeping Current Matters Facebook page. Well, I want to end with this, exactly what I started with. There are forecasts. You have them in the first couple of slides. I think we're going to blow those some numbers away. Not the pricing numbers. I think the pricing is going to remain relatively modest. All right? Appreciation is going to be relatively modest. But the sales numbers, mortgage rates are going down. People are coming out. People are starting to list. Buyers still have strong demand. I think we could do some great numbers on the sales side. I think there's a pent-up demand that's about to be released in the market this spring. And if you want to take advantage of that, you have to work the next 90 days hard. Well, as we say at the end of each one of these editions, never forget, always remember, keeping current matters.